Hello. Welcome to the Stockout. The Stockout is a FreightWaves show about CPG companies, their supply chains, and CPG companies' supply chains. So CPG companies are consumer packaged goods, which is the focus of this show at FreightWaves, one of many that we do. And it's Friday. I'm glad that it is. It's been quite a week. It's been a week with a lot of stock market volatility set off on Wednesday, the big stock market decline on Wednesday. That was caused by the latest inflation numbers that took the market by surprise. I think the main question and sort of line of discussion this week was is that inflation data, more inflationary economy, how is that going to impact the freight transportation market? So I'm going to give some thoughts on that today and also talk about some of the latest data in the world of spot rates, trucking spot rates. Some of the truckstop.com spot rate data spiked up this week. And I'm going to explain why that is and why I think, at least that particular, issue, may be a little bit temporary, still going to be at a high level, but it was a little bit of, I think, a temporary spike this week. And then I'll discuss some of the latest CPG news from around the industry. Very interesting that Tyson sold off its pet food business to General Mills. Seems to be one of the hottest sectors within consumer goods right now is pet food. So I'll talk a little bit about that and a couple other things specific to some of these big CPG companies. But first, a word from our sponsor, Echo Global Logistics. Trust the experts at Echo Global Logistics for all your freight transportation and CPG shipping needs. Whether you are a Fortune 100 CPG company or a specialty food manufacturer, Echo has solutions to fit your needs. With their dedicated team, as well as EchoShip, a self-service shipping portal allowing you to quote, book, ship, and track, Echo has you covered. Technology at your fingertips and experts by your side, 24 hours a day, 7 days a week. To find out how Echo can simplify your transportation management, please visit www.echo.com/CPG today. So thanks as always to Echo, the big logistics company in downtown Chicago, for sponsoring this podcast. And with that, I'll get into the topic of the week. And I think it's sort of the topic that I've been talking about every week. Inflation. This seems like it's almost a show about inflation rather than CPG companies, but I think those two things are sort of joined at the hip, this week. And what happened this week is inflation sort of became elevated, I think, in the minds of most people, with this latest CPI data. So CPI, if you're not familiar, think back to Economics 101. It's the basket of goods that the supposed typical consumer buys at the store. And so those prices on the typical basket of goods rose 4.2% in April from a year earlier. So that's a lot higher than what the government seems to target. They seem to target about 2%. And that's a rise sharply from what that reading was in March, which was 2.6%. So in March, we saw prices rise 2.6% from a year earlier, in April rising 4.2%. So I think the market was expecting a rise from that 2.6. I think 4.2 was a bridge too far, and this had been something that was starting to get more on the top of minds of investors and people in a number of different industries. I know from following the CPG industry, specifically, lots of the analyst questions the last couple of quarters have been on, how are you going to mitigate these rising, input costs? And I think, CPG companies are sort of uniquely exposed to inflation because you look at some of the most inflationary items within the economy. A lot of it is food products, things like corn, which the corn futures are up about double where they were a year ago, and also a lot of inflation for other types of food products. That's just one example. Packaging is rising, transportation costs are rising, of course. So on a month-to-month basis, some of these seasonally adjusted prices rose 0.8%. So a lot of increases in prices just on a sequential basis as well. And it was this 4.2% that rise in April was the most of any 12-month period since 2008. So it has been a while. And 2008 was such an odd year with strong, fairly strong economy in the first half of the year, freight recession that was before it, followed by the big drop off at the end of the year. Sort of another way to look at it here, and maybe if you wanted to take not such a dire stance, would be that CPI was higher by 2.2% versus 2019. So we're a little bit higher relative to pre-pandemic levels. But if the government sort of targets 2%, well, then should it really be 4% higher than what it was 2 years ago? I would say maybe not, but we don't know how quickly it's rising. And then they also have this core price index, which excludes food and energy, that increased 2.4% from a year ago. So that's still sort of above that target of 2% inflation. I would argue that the core price index is much less relevant now, if it ever was relevant, because because it excludes food, and food is some of the most inflationary items in the economy right now, as well as energy. So I don't think there's really too good of a reason to exclude those two things. But since we follow freight so closely, and so many of our customers are involved in either carrying freight, shipping freight, brokering freight. Most everyone or trading freight stocks. They're all sort of involved in one of those things, or freight consultants. They're all involved in the freight industry in some way. And so the question that we've gotten sort of up and down the past week is how is inflation going to impact the freight transportation markets? Well, I have some thoughts on that. I think a little bit of it is on a case-by-case basis. I mean, my sort of background in finance, I spent a lot of time following the railroads and companies that manufacture railroad equipment. And the railroads move a lot of bulk commodities, a lot of things like corn, soybeans, lumber, those type of things. And for those big bulk commodities, those tend to ship in greater volumes when it's a highly inflationary environment, which makes sense. I mean, the commodity sort of by definition is all those products are the same. There's a uniform price for them. You want to sell those commodities at a high when they're priced at a high level. And if you see the price spike, well, that's not much reason to hold on to it any longer. And so you are seeing companies that carry grain, like a lot of the Canadian grain or the Canadian railroads in particular, are hauling a lot of grain, for exports. And so this chart that you're seeing now is the U.S. Class 1 railroad carload volume. This does not include any intermodal units, and it's broken down into the 20 categories reported by the AAR. And you see right in the middle there, grain up 3.5%. This is month over month. So this is a fairly near term look at these things. You see grain up, you see chemicals up, you see in the lower right, lumber and wood products up 9.2%. So a lot of these bulk commodities that I would call either natural resources like grain or lumber, or things that the company can increase the production volume, like chemicals. There's all these big chemical plants in Louisiana and Texas along the Gulf Coast, that those are likely to move in greater volumes to the extent that they can increase the production and get those products to market. They do have to ship them on a railroad or truck to get them to market. Conversely, you see in the middle there, motor vehicles, parts, and carloads down 6.3%. So the prices of motor vehicles way up also an inflationary part of the economy. Basically, everything is inflationary, but that's down because of the with the higher prices. And I think the difference there is the vehicles that move on the railroads, primarily finished vehicles. There are some parts, but it's primarily finished vehicles, and those have been produced in lower volumes because of the semiconductor shortage. There's some reports of companies building the cars without those components, but for the most part, it does sort of shut down some of the production lines. Even Ford shutting down F-150 production lines is sort of the last thing they'd like to do. Those are high margin vehicles. So you do sort of see this dichotomy on on certain areas of the economy. So the question really gets to, okay, we see prices rise. If I'm a shipper, or some carriers ask me, are my customers going to ship more in this inflationary environment? And sort of what I tell them is, well, think about sort of where the constraints are and the reason those prices are rising. And if it's something like there's some component that that they don't have, and therefore those things can't be produced, and that's why they're more scarce, and that's why the prices are rise. Well, then they're going to ship less of them. That sort of describes motor vehicles. If it's something where there's enough in inventory, and it's the prices are rising, now it's just a good time to sell them, and it's more of a commodity type product. Those are going to move in higher volume. So I think there's some some differences there. Is this a sort of a signal of just not being a lot of supply, or is just the demand extremely high? And so it is a little bit on a case to a case basis. I've also heard this week, some people who aren't so concerned about inflation, and sort of the counter argument to inflation, I think, are two things: that the inflation is transitory, that it's just going to be temporary, and it's going to go away, and then prices are going to be 2% a year, and we can handle that. Or the other one is, well, the economy in the first quarter grew at a 6.4% rate, and so sort of who cares that consumer prices are going up 4.2% because the economy is growing 6%, and all things are good, and that's sort of the price you pay for booming economy, strong employment, et cetera, et cetera. Do have a couple of thoughts on each of those things. I think with the strong economic growth, it makes this even more of a K-shaped recovery. And you think about who's going to lose ground to inflation. It's really going to be the people that are on a fixed income, who are maybe older, and have less control over going out and getting themselves a raise. I think the people that have in-demand skills are going to be just fine. I think they'll maybe make progress, because one of the tightest things is the labor market, which there's tightness in the labor market, I think, for all types of labor. And I can talk about some of the ones specifically in CPG here in a minute. But if you can go out and get yourself a raise, then I don't think you have to worry too much about paying 10% more for your consumer personal care products, or maybe 20% more for your groceries, et cetera, et cetera. But it does sort of make this sort of a K-shaped recovery. And then the thought about this being transitory, I think, gets to products on a case-by-case basis as well. When you think about autos and new car prices being high, and now the average used car price is $25,000 for the average used car, which that used to be the price of a new car not too long ago. With that, you think that so new and used car prices would come down, when semiconductor shortage eventually lifts. So, I wouldn't be too opposed to saying, well, specifically in that industry, the inflation, is transitory. I do have more of a problem with calling it transitory when it is something like prices rising because the price of labor is rising. Companies have to pay more in order to have people work at things like the Tyson chicken plant, which they're having a huge amount of issues, because on the labor side, I think it's more of a generational issue, just with the aging of the population, and having fewer workers, and then just with lots of dollars chasing these goods. So I think some of those things where there's not tied to a specific component shortage. I do think the inflation could be longer term in nature, and really create problems for lower income people. So how this relates to CPG companies is CPG companies are already going through sort of this upheaval with last year. Some CPG products were way up, others were way down, depending on whether they catered to eating at home, like General Mills cereal, or being out and about, like Cliff Bars. You sort of think about how this works in the context of inflation. I think it's a lot of just going to be sort of the haves and have-nots of consumption, where the more affluent consumers, the things that target more affluent consumers, things like pet food that needs to be kept in the refrigerator because it's a fresh product that's fresher than what most people eat. Those things are going to do fine, I think. The things that I think are going to struggle are some of these brands that cater to sort of a wider audience, and things that aren't as non-discretionary. because you think of inflation for the sort of the average person. It just means their dollars are not going to go as far, and they're going to have to cut back on something because they don't have a lot of control over how much they drive every day, or how much they eat every day, or their use of their personal care products, but they're going to have to cut back in other areas. And so they'll cut back on things like snacks or candy, or maybe they trade down in some areas as well, which I think brings us to another topic in CPG. In the last year, there's been a lot of growth in the national brands. And in the last year, with people not spending as much money on travel, a lot of people traded up in terms of they bought more expensive versions of products. Instead of buying the sort of the generic store brand, they bought the higher end product. We saw that in pretty much everything, including people buying more expensive bottles of alcohol. Those brands did really well. So I do think it's going to be it sort of throws another wrench in what demand is going to do, in addition to the CPG companies sort of struggles to offset that inflation with with price increases or efficiency increases. Of course, some of the CPG companies have announced significant price increases, while others are holding back a little bit. Some say they're hedged and don't have to do that right now, but those things are coming. But that CPI, keep in mind that 4.2% growth in consumer products. A lot of that's really based on what the products of things were in April, and a lot of what we know from following CPG companies, and what I've been talking about on the Stockout, is a lot of those price increases have not taken place. Things like think Procter and Gamble, one of the very biggest CPG companies. They said that they're going to raise prices on a lot of personal care products, close to 10%, high single digits, starting in September. Well, that data, would not be included in CPI, but will be later on. So I think we're going to, be in for, high inflation, in the monthly data for the next, few months, including in, freight rates. What makes freight rates different than a lot of other inputs that the CPG companies have to deal with is that they are not able to, hedge freight costs, really at all. The way you can hedge, things like corn. If you're exposed to corn, you can buy futures, or fuel. You can hedge that away. Hard to do that with truck movements. FreightWaves tried to do that at its in inception, and it was a good idea. But it's something that companies are exposed to, and something that we follow very closely, and I think something that brought a lot of panic in this past week, because the truckstop.com spot rates came out this week. There they are. In blue, we have dry van, and in purple, or magenta, whatever that is, we have reefer, refrigerated, temperature controlled rates. And the reefer rates were up about 10% from one week to the next, and the dry van rates are up about 5% one week to the next. So now those are sitting way up at 376 for reefer, including fuel surcharges and accessorials, which is a very high rate. You can look back at it about a year ago, and that was less than $2. And then dry van rate, $3.23 a mile, including fuel. And that compares to about $1.60 a year ago. Now, a year ago was a weak time. But that's really, I think, caused some concern, this past week, because those jumped up so quickly and so significantly. Now, I would say that I'm not expecting those to fall back to, let's say, year ago levels anytime soon. But I think this latest spike that you see right there at the right side, that 5 and 10% jump respectively for dry van and reefer, I think that's going to be a little temporary. And I think the reason for that is that a lot of that latest increase was due to the roadside check inspection week, International Road Check Week, where between May 4th and May 6th, the carriers knew about this, that there was going to be ramped up enforcement of road violations and a 72-hour safety blitz, as it was described on FreightWaves.com. And those were particular attention to violations on hours of service rules that truckers may be engaged in or lighting. But And even though those were the focus, it was part of a broader 37-point inspection. And so a lot of carriers choose to stay home during that period of time. They sort of say, well, it's not worth it, driving for those 3 days if I'm going to get a violation and potentially get an out of service order. So there's a lot can go wrong if inspector is inspecting your truck and log a device on a 37-point inspection. And so really, I think that was a big driver of that last week over week increase. We'll see next week when the latest data comes out if those rates go back to where they were the week before. But one thing that gives us sort of comfort that maybe those are a little bit more temporary in nature is when we compare those spot rates to our outbound tender rejection index, which there it is. So the truck stop rates for dry van, including fuel, in blue, the van tender rejection rate in green. Those tend to tie very closely together. We think of tender rejections, those rise in a tight truck market, just as rates do. We think they tend to lead the rates a little bit, and usually they go right in the same direction. And in the past week, we see rates going up, we see tender rejections going down a little bit, and so the other data basically doesn't really corroborate with the rates, the spot rates, rising, and so we sort of come to the conclusion that we think maybe that spot rate is going to be temporary and come on back down the next week or so. So a little bit of good news there, but would still think in general the truck rates are going to be elevated. You think of the companies that move loads on the spot market. They do tend to be a lot of smaller and mid-sized carriers. Carriers that really sort of have that discretion. If you think of an owner operator, if he doesn't want to work, for a few days, he doesn't have to work for a few days. But the companies that are moving, more of the loads in the contract market, do tend to be a lot of the bigger carriers. They tend to be a lot of the carriers that would be more likely candidates for dedicated service. Those carriers, I think, are even less concerned about getting violations because they wouldn't be close to an out of service rule. And I think it's safe to say that some of the larger carriers are the ones that have safer driving records, tend to drive 60 miles an hour in the right lane, have speed governors on their truck, have safety features like lane detection warnings, things of that nature, and I think are less concerned about those inspections. And so I think that's why you can see the tender rejection rate come down a little bit while the spot rates go up. I think over an extended period of time, those things should correlate very closely. So that's a bit of good news. I think moving on, I want to talk a little bit about what's happening specifically to some of the CPG companies. And I think one of the more interesting things here is General Mills. When you hear General Mills, most people think of cereal, Cheerios and the like. They're expanding into pet food. They bought the pet treats unit from Tyson for $1.2 billion. And to give you a sense for what that means, it's 5 times sales, and it's 4 times sales if you back out a $225 million tax credit, back that out of the purchase price, because General Mills is going to get that. So you can sort of see just from there, this is going to be more valuable to General Mills than it would be to Tyson. Tyson says pet food's not a core business for them. General Mills has been expanding into pet food for the last few years. They bought that Blue Buffalo deal in 2018, which they've actually had a lot of success with that. It's grown pretty nicely and become a really good brand for them. So kind of an interesting thing. I mean, it shows that sort of the valuations for pet food segments are higher, certainly than food for the humans would consume. Human food would be traditional food. Companies would trade more like 3 times sales versus the 5 and the 4 adjusted that this deal was at, which I think makes sense because pet food is growing faster. I mean, you see from Nestle's results, pet food was one of their fastest growing segments in the past year. It grew about 9%. I mean, the overall pet food and treat segment grew 9.7% in the last year. And this particular segment that General Mills acquired, or I guess it was General Mills, in general, is doing better than that with their Blue Buffalo brand, grew 13%. So a very hot segment within consumer products space, and including a lot of the fresh pet food and all of those things. So with that, I'll move on to next topic here. I've got a couple more in the last few minutes. Tyson. This sort of goes nicely into the discussion earlier. They said the employee absenteeism is 50% higher than it was before the pandemic. So just people not showing up to Tyson facilities to work, and they're saying that it takes 6 days for them to get done what they should be able to get done in 5 days because of the lack of people. And it's pretty big deal there. So they're raising prices. They wouldn't disclose how much, or raising wages. They didn't disclose how much. I imagine that's because they raise them more for the people they really want to stay. But here, you see prices of chicken rising, 8% in the second quarter. The number of servings of chicken are up 14% at restaurants. Another interesting stat. It's because of this, chicken, battle between the fast food restaurants and those things. So chicken is surging, which that's kind of interesting. We'll see if that's just a fad, and so chicken's getting in shorter supply is what I talked about last week, and part of that's because people are eating more chicken, but it's also because it's having a hard time producing the chicken. Some of the plants that the Tyson had were hurt by the winter storms, down in the south area. So continued issue there with Tyson. The last topic I'm going to talk about in the last couple of minutes, I think, is just kind of a fun one to end the week on. Del Monte is launching a retail bubble tea product called Joyba Bubble Tea. I think I said that right. Joyba Bubble Tea. So it's the first launch of this type of product at retail, and the second to include popping boba. So if you don't know what this is, it's just kind of a fun, drink. Very popular with Gen Z, popular on the West Coast in a lot of the Asian communities, and is kind of an alternative to, going to Starbucks or going out for a drink. If you don't drink or too young to drink, it's just kind of a fun thing, but kind of interesting now that typically this is a product that you would buy at sort of a specialty boutique that's making its way to the grocery aisles, and I guess Del Monte has a product that doesn't need to be kept refrigerated. Maybe you can take it home and have it be refrigerated, but it'll be interesting to see if this makes its way into, in a bigger way. And I think this, creates a whole nother sort of dimension in terms of supply chain and logistics, because they have these bubbles that they call boba, and some of those things are actually imported. There was a shortage of them because of the issues at the West Coast with congestion. So kind of an interesting thing that the beverage industry could have more logistical challenges because of this new potential product category. It could be the first of many introductions. So I thought that was interesting to add things on. And with that, we're getting close on time, but hope everyone has a great weekend, and feel free to reach out to me anytime at mbaudendistel@freightwaves.com. Just my and then my last name there, which is on the screen. But hope everyone has a great weekend.